Okay.
Okay.
Okay, ready when you are. I might just have to pause and let people in as we go.
Okay. Well, perfect. Nice seeing everybody's faces this afternoon, and thank you for joining us for our fourth Wisdom with Women speaker series. We've been really excited to host this via Zoom this year. We have a new format in Zoom. We're doing them in person, so thank you for bearing with us through all of our tech challenges throughout the year. I think that we finally have come up with a format that's working, and we're hoping to extend these into next year. So I'm Allie Chris, certified financial planner with Financial Insights, and I am very excited to introduce Amanda Burrows, who's speaking with us today. Amanda has been with Financial Insights for a little over a year as a wealth advisor, working with high net worth clients. She holds a certified financial planner designation and a bachelor's degree from Washington State University. And she comes from,
Go Cougs!
Yay, Cougs! Yay, Cougs!
I forgot to mute everybody.
Sorry.
Comes from over 11 years of experience in finance. Over the years, she's helped navigate many clients through college planning, divorce, retirement, wealth transfer, and many other financial obstacles that life provides. She hopes today to share her personal and professional experience in long-term investing. Now more than ever, it's important to revisit the basic fundamentals of investing. She hopes this presentation is a meaningful refresher for some and a helpful building block for those who are less experienced. Want to let you know that we are recording this session, and we are going to have a Q&A for Amanda at the end, where you can type your questions into the text box, and I can read them for Amanda. Or if it works out, you can also unmute your screen and ask Amanda directly. So with that, thank you all for being here, and I'll pass the mic over to Amanda.
Thank you, Allie. So let's just get started. So I'm the woman and I'm wise, apparently. So I have things to share. And I'm going to talk about long-term investing. It's a really huge topic. So I want to first say I'm really just going to skim the surface, just to kind of talk about the tip of the iceberg. Like Allie said, to help people who maybe have never invested before, to build a solid foundation about why should I invest for the long term? How do I do it practically? And then how do I do it emotionally, which probably applies, more than ever right now. So why invest? First of all, I think that's a really personal question. Everyone has their own goals and reasons, which is why there's no one investment that fits everybody. I've listed some whys here. So retirement's a common one. College, I have a 2-year-old. I'm thinking about her college fund. A large purchase, charity, travel. Sometimes it's just financial freedom. You want the ability down the road to change careers or, be free to do something else. And then ethics, that's a good one. It's kind of a new space, actually. So we'll talk a little bit about ESG investing. So economic, social, and governance. If you fall into the criteria of where you really want to invest in things that you also agree with, ethically, that's kind of a 20-year-old space. We can now do that. And then if you, I forgot I put that. And then if you want to brag to your neighbor, if you're one of those people that you want to brag about getting Amazon in the 90s or something, I don't know. So that could be a reason why you want to invest for the long term. So let's look at the stock market. So you probably can't see right here, but I have that investing is an act in optimism. So if you want to participate in the growth of the world, if you just think overall, which I do and many do, that the world is going to improve and get better. This is the history of the stock market since 1900. So that's the S&P 500. Gosh, we've been through a lot. We're going through a lot right now, but we've been through the Great Depression, many different wars, Black Monday, not too long ago, the tech boom, and of course the global financial crisis. So through all of these crises, you can see that the stock market has continued to go up and to grow. And it's really designed to do that. I know the news loves to say all-time highs, but I mean, think of how many times they've said that in the history of the stock market. So it shouldn't be big news. We should be growing over time. And if you want to participate in that, if you're optimistic about the future, that's another great reason to invest. And then also just to grow your money. You might not have a specific reason, but an initial investment of $10,000 in 1970 in the S&P 500 would return over 360,000 today. Now, if we reinvested dividends, that's over 1.5 million on a $10,000 investment in 1970. I think that's a great reason to invest for the long term. Hopefully we can keep these sorts of things in mind when, you know, the stock market's going like a roller coaster. And then also, we don't really have a whole lot of choice, right? Because CDs and savings accounts, we're looking at income earned by a $100,000 investment in a 6-month CD. The income generated was $837. So if we were going to try and beat inflation, savings accounts and CDs just aren't doing that. Oh, I'm going to let someone else in really quick. Okay. Okay, so that's the why. And I think that's unique to every person. I think you should talk with your advisor about why you're investing, but then how to invest. Here are some practical, kind of rules to follow to get started on investing. So the first and most important to me is emergency cash. We cannot hold on to a long-term investment if we're constantly liquidating when we have car trouble or when, the washer goes out. And I promise you, the washer only goes out when the stock market is down, okay? That's the only time these things are gonna happen, is when it's not favorable.
True.
So we need to have an emergency fund. We need to have time. The more the merrier when it comes to time in the market. And diversification, I think that one's really important. Risk is gonna be personal, but we need to identify your risk tolerance. And then also, if we're in the accumulation phase of life, we should be reinvesting dividends and systematically buying into the market. What I mean by that, that's like your 401k, you're contributing every month, or maybe you're contributing, to a Roth, or even just an investment account. That's a systematic investment. So emergency cash. We just need to know in today's day and age with low interest rates that it's not an investment. We're really not going to get any return on our cash, on our emergency cash. Which is a huge bummer, but I do think it's necessary for sticking to a long-term plan, because we don't want to have to tap our investments. Even if it's a good time, we don't want to have to tap our investments for emergencies that come up. So we've got to have that cash in place. Let me see if I need to add anybody else. Okay, we're good for now. And then time. So recently, many of us advisors, we've gotten those clients that say, why don't I just sit on the sidelines for a little bit and allow the craziness to go by? We can reinvest later. There's no reason to be in these ups and downs, as far as the swings. And I always come to this slide, because what's really important about long-term investing is staying fully invested. If we miss even the 10 best days, our return gets cut in half. So I'll explain this really quickly. This is performance of a $10,000 investment from the January 2000 and the end of last year. It's about a 6% return annualized, but we've over tripled our money at this point. If we miss just 10 of the best stock market days, we have less than half the return than we would have had if we just stayed fully invested. So this one's really important to think about. If we miss 60 of the best days, we have a negative return. I mean, there's really no point in trying to time the market. I haven't found anybody that's, able to do it effectively. So really, really important when we think about, not wanting to have those down days. The other part of it is 6 of the best 10 days occurred within 2 weeks of the 10 worst days. So hopefully we can think about the light at the end of the tunnel when we have those 10, terrible days in the stock market. They are uncomfortable, but there could be a best day around the corner, and that will affect your return over the long run. Okay, diversification. So that's the process of, when I say diversification, we're doing diversification amongst many different companies as well as different asset classes. So we want bonds, we want short-term, long-term, we want non-US companies, we want small companies, large companies, multi-sector bonds. We do want a little bit of cash. We want non-investment grade. I mean, the list goes on as far as, you know, the different choices that we have. We want some real estate in there. When I think about a long-term investment, I think diversification is really important. And I'll show you on the next slide why that is. So here, if we look at 2005, this is a really scary looking chart, but I promise I'm going to walk you through it. So 2005, the number one performing asset class was emerging market equity. So emerging market companies. And that returned 34.5% that year. So I'd love to have a little bit of that in my portfolio in 2005, right? But fixed income only returned 2.4%. You know, maybe you don't want all of your assets in fixed income because you're kind of the loser for 2005. But if we look at some years where emerging markets did really great, you know, 2005, 6, and 7, they performed really great. And then that following year, they were the worst performing asset class, negative 53.2%. So it is sort of the notion you don't want all of your eggs in one basket. If we have diversification among different companies as well as different asset classes, we should see a ride more like this. So I'm kind of following along the middle here, where we have diversification amongst different asset classes, and we have our portfolios that participate in some of the best performers. Notice that large cap, it was only the best performer in this. That's US large companies. These are the names that everybody wants right now. Everyone's investing in US large cap, but really they were only the winner out of all these years in 2019. Okay, so also good to kind of take a look at the history of different asset classes, what's performing, you know, and then maybe what we should stay away from. Maybe commodities have been in the bottom for quite some time, so we don't need that asset class. But overall, diversification is going to get you a nice average return. Okay, risk. This is a photo of the women's skydiving. I think it was 2014. Allie would know more. But the Guinness Book of World Records for women skydiving. So our very own Allie Chris is a skydiver. I don't know if everybody knows this. I am not. So let's think about risk for a little bit. I am not a skydiver, but when it comes to my money, I am actually very risky. But I think it's important to know yourself, to know if you are willing to skydive with your money when you're looking at investing it, or if you're a skydiver and Allie might have all her money in CDs. I don't know, but it's important to kind of know yourself when it comes to risk, because you don't want to commit to something for a 30+ year time horizon like long-term investing and then be out of your comfort zone. That's just, life is too short for that. We shouldn't be uncomfortable when we're talking about investing for 30+ years. So get to know yourself a little bit about are you the kind of person that's going to look online every 5 minutes at your investments and really communicate that with your advisor? And then also look at the appropriate risk for certain time horizons, right? Because if you're going to use your money for a home in 12 months, the risk for that money it should be very low. And then it might be appropriate for to be a very high risk tolerance for a charity donation that you plan on making in 30+ years, or as a leave bequest. So different time horizons also are going to help you identify which risk is appropriate for which basket of money. Okay, reinvesting dividends and systematically buying. We talked about that a little bit, and I have that we need every investment penny working hard. If we have an initial investment of $10,000, here's that slide again. I just think it's so important. In 1970, we're going to return $360,000, but if we reinvest dividends, so as a company pays a dividend, you are automatically buying more shares. That's what that means. Your return goes north of $1.5 million. So that's huge. That's really important to accumulate more shares. You can do that through dividend reinvesting. And then I also talked about, systematically buying into the market or saving maybe on a monthly basis. Okay, here's an example of time. So we have consistent Chloe invest from ages 25 to 65, and we're assuming she earns 6% return. She's got $393,700. by just $200 saved monthly. Okay, so I forgot that part. So $200 monthly as an investment from age 25 to 65. And then she's got almost $400,000. Late Lila, 10 years later, starts on the same program, invests from 35 to 65, earning the same amount of return, but only has about half the money just from waiting till age 35 to invest. So for those of us, and I'll go over the other two as well, but for those of us who maybe have young kids or grandkids, or maybe are young ourselves, and we think, I'm going to wait until I have a better paying job, or I'm going to wait to invest for XYZ. Hopefully this helps you kind of look at the cost of waiting. So time in the market, I think, is just very, very important when we're talking about an overall return. And you can see here that just even waiting until your mid-30s to start investing could erode your return by half. And then we have Quitter Quincy, invest from age 25 to 35. We have almost the same return. And then Nervous Noah doesn't earn very much because, we just have a 2% return for various reasons, and invest from 25 to 65. So we're just in cash for Nervous Noah, and that's only $147,000. So the same amount of money, $96,000 total for Chloe and Noah, but a huge difference in return by taking a little bit of risk. I should say a fair amount of risk. I won't say a little. Okay, so how do we invest emotionally? This is sometimes the hardest part, right? So we have our plan, we've identified why we want to invest. We've got our money, investing on a monthly basis or whatever our plan might be. But then how do we watch our money go up and down? That's not easy to do. This is kind of a cheeky, just little graph that I saw of emojis, but sometimes we're optimistic, sometimes we're complacent, sometimes we have, extreme anxiety or fear. So I think we should identify, I don't know why I keep stepping. I think we should identify, some common mistakes that some investors make. And the first thing I think you should do is avoid shocking yourself when it comes to investing. Just remind yourself that investing is an act in optimism. A lot of times we're just thinking really short term with our money, even though we know we're not going to use it for another 30 years. So focus on those long-term goals and then expect downturns. And when we're talking about expecting downturns, you should expect them every single year. Really, every single year. It should not come as a shock to you that your money goes down. And here's a chart of annual returns and intra-year declines of the S&P 500. And really throughout this presentation, I'm just talking about the S&P to keep it consistent. I am aware there are other markets, but we're talking about this one. So on average, there's an intra-year drop of 13.8%, but annual returns are still positive in 30 of the last 40 years. So what that means is if we just look at the 80s, 1981, the market was down 17% within that year at some time point, but it ended at a high of 26. So it was positive still for the year. And I think that's really important. We do end on, some bad years. Here's the dot-com bubble. We had 3 really bad years in a row. I completely understand that happens. Of course, we have 2008. That was a terrible year for the stock market. But overall, if the stock market goes down intra-year, doesn't mean it's going to finish that way. So I think that's really important to expect. Every single year, it's going to be a different reason. And all those reasons are going to sound and feel like this has never happened before, and it probably hasn't, but we should still expect something to happen to cause the market to go down. Okay, and then lastly, I'm going to talk a little bit about behavioral finance. There are a lot of different biases that can affect our behavior. I'm just going to talk about 4. The endowment effect, that's placing greater value in something you already own over something you're looking to buy. So that might be you. It might be your neighbor. Think about someone who is really proud of that stock they bought because it's just through the roof. But if you ask them if they're gonna, okay, if it's through the roof and you love that stock, are you gonna buy more? They say, no, price is too high. Okay, so that's maybe the endowment effect. You're going to hold on to that stock because it's going through the roof, even though it might be overvalued. Okay, even though it might not be worth that much, and it might be time to sell or chip off a little bit. You're placing greater value in something that you already own versus something that you might purchase. And then loss aversion bias. That's where you might think that or feel that losing money is way more painful than the reward of gaining it. That one affects a lot of us. I know it affects me sometimes. Sometimes I just feel like I can't take any more pain, and I just want to avoid that pain. But just recognize that that could be a bias. Confirmation bias. That's where you're searching for data that supports a decision you have already made up in your mind. So this happens a lot with me and my husband when it comes to investing. He's convinced he wants to buy something and I'm convinced it's overpriced. So what do? I just search for analysts that agree with me. Okay. I only search for the analysts that confirm my bias that I think this, position is overpriced. So sometimes we do that. And then herd behavior. That one I think is really important right now when we do what other people are doing instead of making independent decisions. I think herd behavior is responsible for a lot of bubbles that we've had in the past. The tech bubble is a great one. When everyone believes that tech is going to do nothing but go up and you're not looking at any fundamentals, you aren't using any of your thinking, you're just wanting to participate in the growth that everybody else is feeling. That's some herd behavior, and that can be that can be pretty harmful, especially when it comes to bubbles. Well, I just flew through that. Wow. And then here are my resources. So let's just shoot with some questions, but I'll just summarize everybody, who maybe just joined. Why we invest, it's going to be a personal reason, but also just to grow our money. It's a really great way to grow your assets over the long term, and then you'll have financial freedom for doing so. How to do it. Make sure that you have cash, make sure you identify your risk, really work with an advisor is what I would say as far as how to do it. I don't think, if you're a first-time investor, you should do it without consulting with someone. I think that would be really beneficial for you in the long term. And then how to do it emotionally, just know to expect those downturns, and then just try not to fall into the different psychological biases that we can experience along the way. Okay, any questions?
I don't have any. No, thank you.
Feel free to unmute and ask questions directly of Amanda. She told me earlier she really wants those complicated investment questions.
I'm playing it pretty safe by just kind of doing an overview of long-term investing.
Do you want us to type us in the chat box or just?
Yeah, Suzanne, I think you can, since we don't have a barrage of questions, I think just asking directly is great.
Okay. I do have a question. Am I too loud? I don't know if I have my volume too loud.
Not at all.
So I'm retired now, and I've been investing, basically since I turned 30 through work. I was lucky they had a matching program for some of our 401k money. So, and through the years, I've been pretty happy with the returns. And I've pretty much gone with the traditional 60-40 between investment strategy between stock funds and bond funds. But now that I'm retired and now that the market can be crazy in these crazy times, do you recommend changing that a little bit or sticking with it?
I think that's a great question. And you're right. Throughout this presentation, I have sort of been alluding to the accumulation phase of life, and investing can be a lot different when we're retired or we're starting to draw income from those investments. Unfortunately, I would defer you to talk with your advisor about your specific plan, because it does depend on whether or not we're withdrawing from those assets and what we're trying to accomplish. I think that, if you're a client who has a pension and Social Security and some other forms of income where you really don't have to draw income off your investment, or not, significant income off your investment, it can make sense when we're living to age 100 plus to keep that money in, aggressively or moderately invested. But I think when we're drawing on our portfolios and we need a more, maybe a smoother ride in retirement, or you feel like you need a smoother ride, I think you should revisit your plan and talk about maybe a new risk tolerance for your assets.
Okay, thank you. And that does bring up another question then with regard to Social Security. And I know Dorothy through the years has touched on this. What is the general consensus of you gals with regard to if you feel that Social Security will be here for another 10, 20 years?
Oh, Dorothy, you should unmute.
I am, okay. Hey, can you hear me, Suzanne?
Yes.
Okay, that's a multi-layered question. Yes,
I know.
Yes, Social Security will be there. The actuality is Medicare is going to have financial issues first before Social Security. Okay. So having said that, it's an individual decision. We've got a program that can help you. How old are you right now?
65.
So your retirement age, full retirement age, I think is age 66, FRE for full Social Security. I've done a seminar every year for the last, I don't know, 5 or 6 years. It's going to be in November. We're finalizing the date by the 1st of next week. It's going to be Zoom again. I really think you should attend it. I will do the Social Security part, and then Maylee Coddington will do the Medicare part and Medicare supplement plans. But just so you know, it really pays to delay Social Security as long as you can, because it grows 8% a year from age 66 to age 70 every single year. Well, 8 times 4 is 32% guaranteed. I thought that they would have made a change in that formula the last go around, but they did not. They closed some other loophole kind of things. So you don't have to wait till 66, 67, 68. It actually grows 0.52% every month. But it actually, you're trying to line up your sources of income. Do you have a pension? I forgot. Yes.
I do. And
yeah.
It will keep me through until I'm 70. So I was more concerned with your feeling with regard to politics. I mean, they're talking about doing away with Social Security, which I find that even kind of hard to believe. But, do you put all your eggs in one basket and say, okay, I'm going to go with it, and hopefully it won't go belly up? And
that's unfortunate. I think, without wading too far into politics, I think both sides of the aisle would think that would be really a really bad decision to do. And in general, if you do have a huge change, there is a retroactive date, and it generally affects people generally in the past 55 and under. So for people that are 55 and over, it generally does not affect them. Okay. I don't think the younger generation, Allie, Amanda, the other young people in our office are probably going to have the 8% a year annualized bump from 66 to 70. Now, when will that take effect? I don't know, but it certainly has a lot to do with the financial security of the system. And in the seminar in November, we do some really good handouts that, and I'm happy to do a separate conference call just on that topic if you would like, for you.
No, that's good. And I have attended the November sessions the last 2 years, and I really
okay. I couldn't remember. Okay. Yeah. I don't think it's going under, at least not for us in our age group.
Thank you.
Thank you, Dorothy, Amanda. So we're still open. We have time, so you can still bring some more questions for Amanda. Please feel free to unmute and fire away.
So this is Liz. So I have a question. You touched in the beginning really briefly about ethics. And I wondered, since we have some time, if you could say a little more about ethical investing and what you meant by that.
Love to. Thank you, Liz. So what I mean by ethical investing, it's really going to be a personal journey. So for myself or for people who maybe want to invest in clean energy, maybe you want to invest in socially diverse companies, maybe you want to make sure that there are women on the boards of some of these companies, or you know, you want to make sure that these companies are going to be around for a long time, and you have ethical standards that you live by, and you want your companies that you invest in to live by those as well. That's sort of a new space. Maybe the last 20 years, there's been ETFs and mutual funds and different ways to participate in the growth of these specific companies and exclude things that maybe you don't believe in or they don't align with your values. Maybe it's tobacco, maybe, I mean, you name it. It really just, you know, it requires you to communicate with your financial advisor and talk about things that are important to you, and then we can align your investments to that, or do our best at least. Does that answer your question, Liz?
Yeah, that was very helpful. Thank you. And I think we're on that path already, but I was just interested to hear your perspective. So since I've got the floor, another thing you talked about a little bit was investing for charitable giving. Could you say a little bit more about that?
Sure. So there are many different ways to invest for charitable giving. That's sort of, you know, it's something you can do in your lifetime while you're alive. It's also something that you can do maybe as a lead bequest in your will, or through something like a trust. There are different ways to set up investments where you can give the bulk of your money to a specific charity, but then live off of the income from the investment. So there's just a ton of different ways. If you're interested in giving to charity, I think it's really important to talk with your advisor about it, because, you know, it is also an important thing to think about with estate planning. The state of Washington does have, you know, an estate tax. So if you have all of this money, you know, it's above the Washington state limit that you're eventually going to be taxed on at your passing. We can talk about different ways that you can maybe have a, you know, give to charity, or even giving to your kids. A lot of people don't realize that there is a gift tax. You can't give more than $15,000 a year per person per beneficiary without having to do some sort of reporting. So all of those strategies, that's why I sort of talked about in the beginning about identifying your goals with your advisor, because there's going to be different, let me get to there. Oh, here we go. There's going to be different investments to customize around each of these goals. Probably a different risk tolerance, a different type of account, you know, a different time horizon. So all of these things, I would say, just get with your advisor as soon as possible when it comes to what you want to accomplish with your money, because we'll probably structure it differently.
Great, thank you.
Yeah.
Hey, Amanda, Dorothy again, could I say another word there?
Yes.
On the charitable, if you are 70 and a half or older, and you have a retirement account like an IRA, a 403B, tax sheltered annuity, a 401k, you probably, maybe you don't, but you probably know that you can make what are called qualified charitable distributions, QCDs. They count for your required minimum distribution that you have to take every year when you're 70 and a half. This year, nobody has to take any distributions, the IRS said, from retirement accounts, but you still can do qualified charitable distributions, and it does not flow to your tax return as a taxable event. So just know that. And when you make the QCDs, qualified charitable distributions, and you don't take the money, or you don't take all of the money and part of it goes to charity, the whole amount, whether you're taking the distribution or part, let's say it's $10,000, you take $5,000 and you send the other $5,000 to various charities or one charity, the whole $10,000 gets to count for your required minimum distribution. Hope I didn't confuse everybody.
No, that's a great point, that still stands for this year as well.
So can I ask a question, Amanda?
Yeah.
Perfect. Okay, so I have had a lot of clients ask me about what, and I don't know the answer. Geez, I want your opinion.
Okay.
I have a lot of people asking me about this upcoming election, especially given COVID happening. And obviously there's so much uncertainty that's happening. And just like in 2008, when I get that question, I obviously in 2008 was not getting it as much as I do now. I'm more progressed in my career now, but I have my personal views about it. I'm just as nervous as anyone else is about what's happening. What advice are you giving to people right now? And are you getting that question? And what are you saying? I really would like your,
Oh, that's great. So I think a lot of people feel that way. So it's a very valid, point to bring up. I think no matter what, when you're looking at politics right now, everyone's just convinced if their guy doesn't win, the world's going to blow up, really. And what I like to do, as an advisor, is just take a look at people who are smarter than me, who have done an analysis on what would happen potentially if we have, a Trump president, or if we have a Biden presidential, if Biden becomes president, and the consequences of both of those from a financial perspective. And if you do that, it's really not a huge catastrophe from a financial perspective. I understand that, socially and morally, a lot of things could happen, for good or bad, but from when we look at investing for the long term and we look at, 4 years, the next 4 years, which is a relatively short time frame for investing, no matter which candidate, takes the seat, analysts are saying that there are consequences, but they're short term, and that nothing should blow up, depending on who's president. Does that help you?
Yeah, that was awesome. Thank you.
Mm-hmm.
Okay, we still have 20 minutes. So if anyone has a burning question or something that they maybe were waiting to answer, maybe they were too nervous to ask, now's your time.
Well, I'd like to revisit that question that Ms. Dunbar asked about the $15,000 per year gift tax. Is that if you gave $20,000, say, as a gift to one of your children, you would pay a gift tax and they would pay a tax for receiving the gift, or is it just the giver?
I'm so glad that you're asking that question so people aren't confused. No, there's no gift tax. So what I mean by that is everyone gets a lifetime amount that you're able to gift without having to pay tax. So but separate from that lifetime amount, you're able to gift $15,000 per year per person. So let's say my daughter Ruby, if I want to give her $15,000 and then my husband also gives her $15,000, that's technically $30,000 that we can give to Ruby, and that can go unreported, and you do not have to subtract it against your lifetime tax or gift amount. So hopefully that makes sense. And does anyone know the new lifetime gift amount? It's 1.9 million. Anyway, I'd have to look up what this year's lifetime gift amount is that you're able to gift. But hopefully that clarifies it for you. It just means that the gift can go unreported. Doesn't mean that you have to pay tax on neither person should have to pay tax on the 5,000. I don't know if you're married or not, but if you are, you could gift 30,000 as a couple.
Well, my situation, I'm a widow, but I have a 96-year-old mother, and we recently sold her house because we don't know eventually, if she'll need care in an assisted living or whatever. But she has made noises like she'd like to give her kids some of that money, and I'm very concerned because we don't want to shortchange her because the cost of care is tremendous. But we'd also like to go a little bit with her wishes if that's what she desires. So this was an interesting topic for me, and I appreciate your help. Thank you.
Sure. I would definitely talk with a tax advisor about a strategy for your mom, just to make sure you don't want anything messy or have to do extra reporting.
Right. Thank you.
Yeah.
Okay, great. So does anyone have any other questions
you.
for Amanda?
Sorry, Lily just added that the lifetime gift tax is not, it's 11.58 million.
Yeah,
So we're good.
5.
Thank you. Same as the estate tax this year.
Oh, that was Bev Cox.
And can I say
Bev-
something? Oh, sorry.
That was Bev Cox, CFP, as well, and Gig Harbor, who made a comment in the chat box as well. So thank you. We have a lot of,
Yeah, not 11.9. No one do 11.9. It's 11.58. Sorry to overestimate.
Perfect.
So, Amanda,
anyone-
Dorothy again, can I make a comment to Suzanne?
Sure.
So Suzanne, on the on the gifting from your mom to all of you, I don't know what the size of her estate is. As you said, care is really expensive. And I have run into this a couple times. If people gift and they're run out of money and they go on Medicaid, there is a 5-year look back period where they will penalize you in terms of getting care, depending on when you gifted, the amount you gifted, and it's just a formula. But just be aware that there's a 5-year look back period that you have to get past if you use all, because this happened to my mom, you use all your money, and you can't go on Medicaid if you've gifted within that basically within that 5-year period. Thank you.
Great. Thank you for clarification.
Okay. Is there any lasting questions to get us going?
I guess the last question I have, because it's been a while since I've talked to an advisor. I know Allie keeps, and Kate keeps saying, do you want to come in and have an a one-on-one? And I haven't for a couple of years. And now because of COVID, that's not really an option, but would Zoom meetings for one-on-ones be possible?
Absolutely. So our office, all of our advisors, Amanda, myself, Mike, Dorothy, Reese, Ernest, Daniel, Brian, all of us are doing Zoom meetings. We've been doing more Zoom meetings than we're doing in-person meetings. We are offering a few rare in-person meetings, but Zoom seems to be the standard right now. So yes, to answer your question, we can absolutely do a Zoom meeting.
Great. Thank you.
Am I audible?
Yeah,
You are.
heard you.
Okay, I have a question about my grandkids. If I were to open like a Roth account for each of them at $10,000 now when they're just almost college age, would that work against them when they apply for scholarships when they are college age?
So there's a lot in there with the Roth. Roth IRAs have sort of a different rule. I'm wondering if you're thinking about 529 accounts for college savings.
No, I just want to
Roth.
start an account for them, not for college necessarily, but for their own income.
Okay, so a Roth IRA is really only available to kids who have employment income. So, and you can only contribute a certain amount per year. 10,000 would be too high, and you can only contribute, if oh wait, oh sorry, wasn't a message for me. And so if they made, let's say, $5,000 in 2020, from their own employment, you could gift to a Roth, but then they would not be able to withdraw that money, until 5 years. They have to have the account for 5 years, and they also have to be 59 and a half to withdraw any of the income from it. So if you're looking for something like that, for really long-term investing, I think a Roth account is a great idea, but you have to follow kind of the Roth IRA rules and guidelines. So I would say, it just depends on what you want them to use that money for. If you want them to wait until they're retired to be able to access that money, I think that's great, but they do have to have employment income, and you can only gift, as much as they made, or, the limitation for this year for 2020, the maximum amount you can put in a Roth IRA.
Sounds perfect to me.
Okay.
Tie that money up so they can't get it.
Yeah, there you go.
until they're old when they really need it.
Yeah, right.
Okay.
No, Roth IRAs are great. I honestly think we should do, another seminar on just the different types of accounts, as far as, the different types of retirement accounts or college savings accounts. I mean, like I said, these different goals that you have for different people and for different reasons, I really think, you should talk with an advisor, because there is probably a specific account for that goal. And there's so many benefits when it comes to taxes or long-term savings or, whatever the case may be. I would definitely find, the right type of account for whatever you want to accomplish.
Would that income work against them though when they applied for scholarships?
No. Their employment income would be counted, but retirement accounts, they're not going to see retirement accounts for that person when they apply for college. Mm-hmm.
Sounds pretty good to me.
Mm-hmm.
I'll give some serious thought to that. Thank you.
Yeah.
Fantastic. Does anyone, just one more last call for questions and then we'll close it out. Okay, there's so much good information in there, Amanda. Thank you so much for sharing your wisdom with us today. If anyone is interested, we do have 2 more speaker sessions for the remainder of the year. We have one about business ethics of business management in October, and then November, as Dorothy mentioned, is Medicare and Social Security. Liliana is going to do a tax update in the spring, and we're going to extend our Wisdom with Women series all the way into 2021. There'll be new topics with new female professionals in our area all throughout. So stay tuned in your email to see those. Let us know if there's any other topics. You can put it in the group chat. If there's any other topics that you would like to see us present on, please feel free to put it in the chat, and we'll take some notes so that we have some good topics for next year as we go into our next session. So thank you for joining us, and have a wonderful afternoon.
Bye.
Great job, Amanda.
Bye. Thank you, everyone.
Good job, Amanda.
Oh, somehow I finally got a full screen. Yay for me. Thank you. It was fun.